How do you measure the timing of the market? Stay tuned. Welcome to this week's edition of NoteSchool TV, and you have it this week. We are doing the monthly update, the July monthly update, and you are in for a real treat with all of the things that are happening in the market right now. So we're going to get to that in just a second, but before we do, make sure and like this episode. Yep, go ahead and hit that like button. And if you have not already subscribed to our NoteSchool TV channel, make sure and do that as well. And then hit that bell notification so that you will be reminded when we go live. When? Well, every Wednesday at 11:05 Central Time. Also, I know I ask you this every week, folks, but make sure and share your comments with us, guys. We love to hear from you. We love to hear what's going on in your market or what your thought process is on the market as well. So please share that with us in any comments you may have. And if you would like to know what else we do or what we really do at NoteSchool on a daily basis, simply go to noteschool.com/TV. Again, noteschool.com/TV. And we would love to have a conversation with you and get you into one of our 2-hour master classes. More about that at the end of the show. So what I want to do now is bring on, our Chief Visionary Officer, founder of NoteSchool, my friend, Mr. W. Eddie Speed.
Good morning.
Good morning, sir. How are you?
I'm good. We are
busy times, right?
We are busy. I said this to our show producer a moment ago, and I want to say it to everybody. Joe built this slide deck. I had really, honestly, almost nothing to do with it. Joe works at this market information and data scraping and stuff all the time, and he puts a lot of energy and effort into it. And Joe, I think as we kind of start the show today, we're going to talk about the most important part of this, and this is why this matters.
Absolutely. So, Eddie, our theme is timing. So a few days ago, I think it was last week, you were on a was it a podcast?
Well, there's a slide here in a minute but I've talked a lot about this. Like, people ask me, like, why do you guys spend so much time with all this market information? Like, you understand, if we produce a 35-minute show about the market update, all the effort, the energy, all that we do relative to trying to put all this data together and share it with you guys. Mm-hmm. First of all, we use it. We make our decisions based on this information. We're just sharing what we're thinking, sharing a little gray hair, right, Joe?
Yeah.
So let's bring it up. All of these things that we do, all this time that we spend about the market update and commercial real estate and residential and the mortgage industry and credit and how easy it is to get a loan and all these decisions, availability of housing, what's happening in banking, all of this is so that we can make a most important decision, and that is, where are we at in the market? Right. So the theme of this market update this week, for this month, is timing.
Yeah.
Right? Click this next slide, Joe. So my friend, Jim Ingersoll, great guy, super good cat. And I would say not only Jim, but I would say virtually all of his, the people that are facilitators for this mastermind, this Facebook group has 350,000 real estate investors in it. Literally, wow. I'm not kidding. Right. So if you're not in this group, by the way, you should join. And these are some really solid industry, highly ethical, good people that have this group and they're the facilitators. And I'd say most of the facilitators have been to NoteSchool in some way or another, and some of them at a real deep level. So this was a post
Right.
Right. This was about in the last week. And just a guy, I think Kenneth asked a really smart question.
Very
Smart
good
question, Kenneth.
Yeah,
Right?
absolutely,
What's
dude.
the biggest lesson you've learned from real estate investment gone wrong, and how did it shape the future of strategies? So Kenneth is one of the 350,000 people in his Facebook group. And amazingly, Joe, my answer got like one of the top comments.
That does not amaze
Facebook,
me at
by the way.
all.
So if you're waiting for me to respond to a whole bunch of Facebook stuff, I barely say happy birthday to my best buddies, right? It's just because Facebook, the problem is when you get off into controversial topics, you got to stay on it. And then you got people it's just difficult when you can't explain yourself the way I like to do it. Right. So I thought my answer was relative to why market information is so important. It's far better to do only an average job at the right time in the market than a perfect job and the time the market wrong.
That's it.
So if you time the market wrong, it doesn't matter if your processes are perfect. Right. The market's not going to be kind to you.
It's not.
If you time the market and it's good, then you don't have to be perfect.
Right.
So people say, why does NoteSchool put so much emphasis on the market and where we're at in the market? It's because you don't know timing unless you know the weather report.
There you go.
Joe, if we were professional fishermen, if we were professional pilots, by the way, I don't know that you guys know this. Joe's got a couple of 1,000 hours in the seat flying, right? Mm-hmm. Joe, flying and being on the water, two things you've done a lot. The weather's pretty significant.
Well, you're exactly right. You've lost more good pilots to not paying attention to the weather and boaters as well than engine failure. That's for sure.
Yeah. So the big thing that we're trying to say is these are decisions that we make. We're sharing them with you. We hope they're of value. Yeah. We sort through hundreds of pieces of information to come up with what we think this month is the most. So, Joe, let's crack it open.
Let's go to the housing market. And, Eddie, we will start out with, well, according to National Mortgage News, and source a lot of data from these guys. Very good. Annual home price growth hits lowest level since 2012, right? So, Eddie, this starts out right here. Can't draw a straight line in 22, and this is what's happened really in a year.
In a year, yeah. So I mean, there are markets that are still having some lift.
Yes,
there definitely are markets that are having some below lift that are definitely declining in value, and so this is just a trend and awareness. Joe, how can you have a housing shortage and a steadily decreasing appreciation of property? So there must be some other variable to understand to know why this is happening.
There's a lot of variables, Eddie. So interestingly enough, this is from Redfin and from National Mortgage News. Just 1% of the nation's homes have changed hands this year, the lowest share in at least a decade. So, Eddie, this is a pretty big deal, right?
Well, you have low volume. Mm-hmm. We train a lot of realtors, by the way.
Yes, we do.
Realtors are probably one of our top 5 clients that come to NoteSchool. Joe, I do a presentation all the time, including today, to a big group of realtors, literally today, this afternoon. And I do it all the time. And it's because they have a real estate brokerage. They're doing great at that, but they're trying to reinvent themselves, right? They're trying to add something to their business that changes their legacy and their net worth.
Right. Yeah, absolutely.
And when houses aren't selling, commissions aren't flying.
Well, that's it. And, Eddie, we know that everyone, right, has to reinvent themselves every few years because, well, the times change, right? We go back to the timing issue. Times change, and we have to change with those times, or well, we get left behind, right?
Think about it like this, Joe. If only 1% of houses changed hands last year, the average time somebody owns a house, if this trend continued, is 100 years.
Yeah, well, there you go. Good Lord. Wow, that'll slap you, won't it?
Yeah. All right, let's go on here.
Existing home sales. National Association of Realtors, NAR, and Mr. Lawrence Yoon, which is their chief forecast analyst. Well, you can see that we've got 20, we've got 22, and then we're over here at 2023. And we've got bracketed there. Well, you can see this was right at the beginning and right as the pandemic heated up, right, Eddie?
Yeah.
And then as we started seeing the lower interest rates, well, shoots way up through the roof here. And then now that we've came over and we've got these 3 or 4 different variables with people staying in their homes longer, and we've got less inventory, and we've got there's a lot of different factors that go into this.
Let me make a point on, if you look straight up at the bottom where it says 22, look straight up, you know, and look at that graph, and it's falling like a rock, is in direct correlation to mortgage rates.
Yep.
If you looked at mortgage rates, then all of a sudden, as mortgage rates got higher, sales got less.
Right.
Okay.
Well, and we started out
and that's timing, Joe. That's timing.
That's it.
Fact check us.
Yeah.
Go back and look at NoteSchool TVs that we were doing in late 2021, last quarter of 2021.
Right.
Joe, every episode we talked about inflation. Every episode we talked about the counter to inflation is rising rates.
Yep.
Right. So when this happened, Joe, we weren't sitting here with our hands in our pockets going, man, we can't believe that rates went up. Right. And that's why we're saying that we're trying to read where the hockey puck is going, not where it currently is.
And you know what's happened is for our business is that when rates were 3% and we were talking about seller financing, really is going to be somewhere between, let's call it 7 and 9. People are, well, gosh, that's a really high rate, but now it's normal, right?
Well, once again, when rates were really low, then you know we were focused in NoteSchool in a different area, more like getting the seller to carry terms and so forth, and tax advantages. Now, all of a sudden, now we're at a point where it makes more sense. And we're going to talk about this as we progress, but it makes more sense in many cases, not in every case, but in many cases, it makes more sense to seller finance your rental than to continue to collect rents.
That's huge.
We'll talk about
expand on that, right?
Hold on. We'll talk about that as we progress.
Okay. So again, according to NAR, the median price now is $410. And these are the latest numbers. Second highest June on record. June was 413,800. Time on markets went up to 18 days from 14 days. Wow, that's not a big jump, Eddie, from June of 22. But remember, by June of 22, rates were in the mid 6s.
Yeah.
First-time home buyers, no major changes there. 27% down from 28% last month. So that's just an anomaly probably. But all cash buyers up to 26% from 25% last month. So that stays about the same, and it has for several years now.
Yeah, and a lot of that is relative to demographics of who's paying for cash and where they're buying, what kind of property they're buying, and so forth and so on.
Yeah. So let's look at this. And this has nothing to do, guys, with property insurance, even though there are several states. I live in Florida, so I live in one of them that has some insurance issues. But with inflation tanking and the economy weakening, the Fed delivers an insurance hike. So we'll talk a little bit about this in the next few slides here, but I'm pretty sure that a little bit later today, when Eddie, my friend and Eddie's friend, Mr. Jay Powell, We're most are anticipating a 25 basis point rise in rates. So, Eddie, this is the single family, this darker line, or single family rental number. Look at that.
Wow.
And then look at the housing piece there is still the blue, and it's way up there. That's a big disparity, isn't it? And that's forecasting through the next, through 2024.
Yeah. Yeah, I mean, there's no doubt that, there's a lot of reality that is set into play with people with rentals. And we're not throwing rentals under the bus, but we are saying that there are, I'll tell you one thing, Joe, our NoteSchool audience, our new members of NoteSchool are selling houses that were rentals and now owner financing them. They're doing it at a rate that I don't believe I've seen in at least a dozen years.
It is, again, we go back to timing. This is a note time, right? It's what it is, and people are taking advantage of that. Eddie, I thought this was a good, and I was looking late last night, and so National Mortgage Professional, great publication, by the way. Housing market has a 6% problem. Redfin says nearly everyone with a mortgage, and that's true, has a rate below 6%. So they're unwilling to sell. And you can see the numbers here. 91% of mortgage homes have a rate below 6%. Then you've got 5%, 4%, 3%. Eddie, there are ways in the note business and what we're doing that this works really well for us, doesn't it?
Yeah, there's certainly people that, have not so much consumers. The average consumer that isn't watching this show because they're not interested in real estate. They're probably not going to figure out seller financing, maybe except for the fact that we train their realtor, and their realtor now gets it. But there's a lot of people with investment properties with low rates that can sell on a wrap note. And this is becoming a standard that we're seeing more and more of. So
yeah. And again, you've got folks that need to move, and obviously we can help them through that process. So Eddie, this was a deal from Deal Lab yesterday. Deal Lab, we have 3 Deal Labs a week in our membership, guys, and it's Mondays is all about performing loans and selling partials, pieces of the loans. Tuesday is our Creative Terms Tuesday, where we bust up deals on with creative financing, buying and selling on terms. And we have a third Deal Lab on Wednesdays where we talk about we review non-performing loans, and we go through that process. So this was yesterday, and this property is in Tampa, Eddie.
Yeah, so this is a Tampa property. This would, in the old days, this was kind of a working class type house, a shotgun house, where I was raised is what they call it. And so the bottom line is that he has an underlying payment mortgage of $785, and he can sell it with $50,000 down and create a cash flow of $21,21. And so when you're really looking at this deal, then it just makes, and this guy's a veteran landlord. I mean, he is not a rookie. He's been doing this north of 20 years, but he's just like, the math here makes way more sense to collect, over $1,350 a month net income.
Yes.
Versus trying to do something else with it. So I just think this is kind of the flavor of the day with us. We're having students come to us every day and say, what if I did this with my rental portfolio, and all of a sudden I can pull some money out of it with a down payment, and then it'll be a cash flow machine. And it's just hard to deny. This property, I'm guessing, compared to a rental, this property is going to make 3 times the money as a seller finance note as it does as a rental. So enough said on that. It's just an
Eddie, and again, guys, this is just math, right? This, and then you've got 4.5 to 8. That's just math, right?
Yeah, the top piece is the underlying debt. The bottom is what he can sell it for, and it produces a net income of $13.66. So, all right, thank you for sharing that.
Yep. So banks and lending, Eddie. So yeah, we're still up there for the best borrowers. We're still up there, just a tick under 7, right?
Yeah.
And interestingly enough, last year, right? So we're there and we're here, and this was right as rates started climbing. But then we look at from the rate to really the actual annual percentage rate, Eddie.
Yeah, everybody knows that when you see a rate quoted, it's not necessarily the actual rate. The rate on the note is not the effective rate you're paying. Right. And that is because of fees, right? So the APR, the annual percentage rate, it takes into account the fees, and we like to go show this number because that's really the effective rate. Joe, this is somebody with a pretty high credit, 740 to 760 credit, 20% down. It's a Texas loan. We picked Texas because it's considered to be a good, really good market. And Joe, a 30-year fixed rate is just under 7.4% interest. Look at that old 10-year arm down there, Joe. Joe, that thing's really killing it.
It's tough selling arms right now. I'm just saying.
Yeah, that's not doing so good. Anyway, that's just the market. That's the last slide is the cost of money.
Right.
Okay. This, I believe, is a more important factor. This is the availability of money. So you see right there when the virus started, the index before the virus started was basically about 185. Today it's at 96. So about literally 50% of the people that could get a mortgage before the virus can't get one today. Right. And this is why seller financing is such a big deal. You're seller financing to a pool of people, Joe, that otherwise are wonderful people. They've just been left behind by traditional mortgage underwriting standards.
They're great borrowers. They have money down. They've got great credit. They just happen to be entrepreneurs, gig workers.
When the market leaves something behind, the entrepreneur figures out how to fill that gap.
Pick it up. Yep.
And so we're having students that are selling properties with owner financing and finding amazingly good borrowers for all of these reasons. So all of this makes perfect sense. And all right, Joe, the banking landscape, we've talked a lot about banking. Okay.
Yeah.
Okay. And people say, well, banking is more related to commercial real estate. But let me tell you some facts. When banks are struggling, there's an inordinate amount of discounted notes that are available.
Absolutely.
Okay. Absolutely. That has been a truth from the time I entered this market in 1980. And so let's talk about the banks and what they're facing and how that void could be an opportunity.
Well, it is. So, and this is the pain for the banks, right? It's interest rates are rising, and then losses on commercial loans, and then having to, we talked about this on the episode last week, the heightened regulatory scrutiny where banks are having to, add more reserves, and reserves are riskless. You can't loan those reserves, right? You got to keep them in house to cover the losses on loans that you have on your books.
That's it. You're talking about, the average bank is $88 billion, and you're going to go change their reserves, and add 20% to it. Well, 20%. So just think in terms of most banks today, the average capital cash that they have to have in the bank, net worth, so to speak, is 6%. So if you went to 20% more, which is call it another 1.5, then all of a sudden you're talking about a lot of money.
Yeah.
A lot of money.
So Eddie, this is really the piece that will kind of shock some people, right? Half the country's banks will likely be swallowed by competitors in the next decade. And that's according to Fitch analysis, Chris Wolf. So do we go from 4,700 banks to 2,300 banks, Eddie?
I think the train's left the station.
I think it has. We have more banks than probably the rest of the world put together if we really looked at it. Certainly more than all the G7 countries.
By the way, every time you have a bank that's taken over by another bank, that acquiring bank has certain loans that it won't take along with the deal, is how it typically works. Putbacks.
Yeah. And
those putbacks are loans that generally can be sold at a discount, or assets that are sold at a discount. And Joe, I'm going to raise my hand. I'm in. I'm in.
Well, yeah. I mean, if you want us to take it over, we'll take this slice right here on the top. It's just this big slice on the bottom that we don't want.
Well, that's what the banks say. But we say
we want
that
take over.
Slice. Yeah. The banks are saying for us to go take over all the other bank operations and their deposits and their loans, we'll take these, but we won't take these. And those loans are we're little rabbits, and that's our briar patch.
So high mortgage rates will weigh on the market for years, Eddie. U.S. properties face, and we talk about, a lot of people say, oh, the market's going to crash, right? But, is it going to adjust? Probably, but nobody's, it's really not going to be this just fall through the
housing is very different than commercial real estate.
Yeah.
Housing has a dent in it. I think commercial real estate has a canyon in it.
Yeah. And so, Eddie, Mr. Powell, Chairman Powell, will here in an hour or so, 2 Eastern time, he will make his announcement about whether he's going to the Fed's going to raise rates again. And so the market is saying that, this afternoon, 2 o'clock, we'll see. And then thinking probably again in September at the Fed's Open Market Committee meeting.
Yep, I think it's going to happen, but we'll see.
Central banks say lower rates aren't in the cards. Ongoing quantitative tightening. That's a mouthful, isn't it? It's just tightening the market, tightening the money supply. And again, guys, this is where seller financing, creative seller financing fills that gap, Eddie. It's just it becomes one of those things. Well, market, it's going to transition. And, Pew Research, they say that, more than 36 million Americans have used seller financing, right? So it's just going to get bigger. Of course, the market volatility and the bank's balance sheets and all of those things and higher credit concerns.
Yeah. So, I think the banking situation is going to be a story of the future. And we just are trying to draw a clarity to, like, why does this matter to us? It matters to us because when banks are having trouble, it is always pushed a higher inventory of notes available to us, discounted notes.
Absolutely.
Absolutely. And so we're doing it, understanding our market timing. We're not like, the banks have trouble. We're just drawing clarity to the fact that when they do, it produces an opportunity.
And speaking of opportunities, the Daily Who, which is it's the Insight for Digital Economy, this is $78 billion, Eddie. Exit U.S. banking system in 1 week. And this isn't just from J.P. Morgan. This is just Jamie Dimon from J.P. Morgan saying, hey, there's some deposit flights here. Eddie, read that paragraph below that.
According to the Fed, $742 billion in deposits has left the banking system in the last year. And the U.S. banks now have a total of $17.28 trillion in deposits and on their balance sheets. Yeah. And the bottom line is, yes, deposits are leaving the market for all the reasons that we are very aware of. And we've shown you these charts of the big banks and their kind of decline in deposits versus the smaller banks, the banks less than the top 25 banks. Mm-hmm. And that looks like a boom. That looks like a Grand Canyon shot, you know.
So Eddie, you said this, we've talked about this. I think we've talked about it a little bit last week, but so if this money is coming out of the out of the banks and places like that, people are looking, if you're looking for investors to invest in real estate, do you think this is a good time with what's happening here?
Well, once again, we know there's a significant lack of new commercially originated loans.
Right.
And that tells us that the syndicators for multifamily or storage or whatever, these investors that would normally be investing in that type of property, that type of an investment, they're all of a sudden, now they're forced with trying to find something else to invest their money in. Yeah. Right. Yeah. So it's just a reallocation of where the money goes. Right. In the market. So notes become the new alternative investment compared to the more traditional. And we think of the most traditional as being multifamily. And so it just sort of seems to be the water, the money to us and the flow of the money and so forth. So, all right, Joe.
Let's talk about commercial here. So, Eddie, commercial real estate lending fell for the first time in the last 2 years as market conditions tighten.
Yeah, I mean, this is the production in lending is way off. The credit tightening, the criteria under which they'll make a loan has drastically changed. We've had that on NoteSchool TV in the past couple of months. And Joe, I'm continually surprised at people that don't know it.
I know.
And this tells us that let's keep doing this research. I was sharing with a very sophisticated real estate investor, a friend of mine out in California last week, very sharp guy, right? But he's not really a commercial real estate guy. And I was telling him the down payment requirements had doubled and the debt service coverage ratio had, the income they require that you keep had tripled from where it was. And he goes, wow. And so it just tells us that awareness of what's happening then starts significantly influencing the decisions we make. So all of this to be said that, we can tell stories about commercial lending, I think, all day and all night. I'll go back to what the editor in the mid-year TREP report said, significant headwinds.
Yeah. So speaking of the TREP report, Eddie, great segue here. So multifamily syndicators come under scrutiny. Everything to know about the exposures of commercial real estate, CLOs, collateralized debt obligations, and floating debt rate. So, Eddie, this was in the TREP. This is in the TREP report. I picked it up yesterday, and this is a cross section of 5 syndicators, multifamily syndicators that have had the biggest growth in the last, let's call it, since 2020. Yeah. Right. So this is the commercial collateralized debt obligations, and this is just the collateralized debt obligations and the commercial mortgage-backed security piece here. And we're talking, is it a lot of money? $3.719 billion, $4.219 billion over here. But you look at these numbers here, as far as the weighted average debt coverage, debt service coverage ratio is less than.
Yeah. Let's just say it this way, boys and girls: they're not cash flowing.
Look at that. No. And so here's the challenge. I'm going to read a couple of different comments from this because I think it's very important. And we're not, again, 96% of these loans are floating rate loans, right? Yeah. most of them are they're interest only loans, and this comment says, based on the weighted average debt service coverage ratio, net cash flow for the floating rate loans are significantly lower, 1.04 compared to 1.79 for the fixed rate loans. And then a couple of other points here. About 80% of these multifamily loans are set to mature in the next 18 months or by the end of 2024. And debt service ratio, debt coverage service ratio is really a big deal. And
let me frame this up, Joe. Again, I'm just going to restate what you said. This isn't the entire multifamily industry. This is 5 very large operators in the space, and this is their story. I think what the TREP report is trying to tell us is this story is not unique only to these 5 operators.
Right. This is just a cross section.
But this is a reflection of what Joe and I keep looking at. But this is, Joe, I don't know what an ugly data report looks like, but this is ugly.
Yeah. So as TREP wraps this up, they say many of these loans have maturity extension options, which is good, right? But maturity extension is subject to certain performance conditions. First, a certain debt service coverage ratio level must be in place. Failure to reach that threshold can force borrowers to repay principal to effectively buy up the debt service coverage ratio. What does that mean, Eddie?
Well, that means you're going to get a letter from the syndicator, and he's going to say, Joe, I'm hoping you had a good July.
Yeah.
No, we've got to go raise a lot of money so that our bank will refinance our deal because we got to go drastically pay down our debt.
But Eddie, it gets better. So there's one more. Second, lenders want to be insulated against future rate hikes. The nuances can be complex, but lenders want to make sure higher rates don't result in borrowers' debt service coverage ratios going below 1.25. Accordingly, borrowers must buy, often very expensive, interest rate caps to protect the lender. The cost of caps surpasses the regular expenses for operating expenses and often results in capital calls for investors, what you just said.
Can you stretch a board?
I don't know. I don't think so. Final thought here is the results is that multifamily syndicators are feeling liquidity pain and have nowhere to turn to delever these loans. So again, it's well, it is what it is, right?
Listen, the most immediate effect of this is capital that is going to be coming to the note space because multifamily deals, the math isn't working as well. We're not saying every deal doesn't work. That would be ridiculous. We're saying a lot of deals don't work today. In fact, most deals in multifamily space don't work today. So the immediate benefit is that we're going to see people with investable capital, passive investors coming into our space. The play down the road as the market likely is going to have a significant drop is going to be a play in that space. Mm-hmm. But there's a pause button where if you better know that you have a real bargain if you're going to play in that space today.
Right.
A lot easier to invest when stuff is cheaper, right, Joe?
Well, Eddie, it's all about timing. When the rates were low, it was good timing, right? But as things changed and the market changed, and Eddie, you and I talked about this earlier, and are there a few more multifamily properties coming online?
Yeah, there is if you drive around any major city in the United States, you see a significant amount of multifamily construction, not yet occupied, not yet finished. And there's a big watch on that story in the market. And that is measuring the timing of inventory coming online, not just currently what's currently online. Right.
Right.
So, anyway,
right, let's talk about the single family rental market here, Eddie. Wallet Hub, 23 best and worst places to rent. These are just the top 10 best, the top 10 worst. And so, there it is. We've got about, and the National Multifamily Housing Council says that there is approximately 44 million Americans that do rent right now.
No doubt. And these are, when you look at this side, there's clearly economics to it for sure. Lots to be said. We're trying to pay attention to all variables on the multifamily side. Once again, we've got plenty of friends in the business.
Yeah.
We're not running around there just and that they've got issues. But when you're not aware of it, then you're going to make a blind decision. And when you become aware of it, and particularly aware of how that leads to an opportunity,
right,
then it starts drastically changing it. And that's what we're trying to share with you guys.
It's not it's not what you know that gets you, it's what you don't know. And in this case, if the money is out there, the investors are out there going to be looking for a place, and seller financing is going to take care of a lot of the folks that just as banking tightens, right? So finally, Eddie, let's just latest NPL situation from Black Knight.
So just put bottom line. If you go right to the bottom, Joe, you can just circle that kind of whole bottom section there. That's the number of loans that are 30 plus days delinquent. There is just under 2 million. Joe, 11% of FHA loans are delinquent.
Yeah.
We are seeing a waterfall of these loans now cusping over, like I've had in the last 2 weeks in our trade desk. We are seeing a lot of inventory of non-performing notes that we knew existed,
right?
But it was still shadow. It hadn't kind of come out into the surface yet. It's now coming over the cusp. And so we're going to see this happening. By the way, the age of these loans is seriously delinquent. Darren Bloomquist told us that the delinquency on the majority of these loans that are 90 plus days delinquent is 600 plus days delinquent.
Wow.
And he's with auction.com, of course. So anyway, they're not just mildly delinquent. These are loans that are going to end up in a foreclosure process.
Yep.
These aren't people that just had a little speed bump. They're loans that got delinquent probably because of the virus, and they just haven't gotten current.
So Eddie bragged on me a little bit at the beginning of the show, and so I'm going to brag on him a little bit now. So we have this mutual admiration society, and we'll pull the slides down now. But so Eddie, you called this a while ago, right? You called this back probably March, April, May, June of 2020, and said, guys, we're looking ahead here. And that's what the guy does, right? So yeah.
Well, let me tell you something. Sometimes we get lucky and get something right.
Right.
The more information we have, the more likely we are to get things right. And this is the most popular series that we do every month, our monthly update. It's watched, more than other episodes. Our other episodes are great, by the way.
Right.
But this gets shared and stuff. So if this means something, you guys share this out in the marketplace, share it on some groups that you're in, some Facebook groups and stuff. We're not trying to call anything other than what it is, right? We're not trying to call it worse than it is. We're not trying to call it better than it is. We're trying to throw it right down the middle. I can tell you this with 1,000% integrity, Joe, as we close. This is the same information that we make our decisions based off of. Exactly. And so we're just simply sharing a lot of research that because we are very active investors in the market, we don't just have a school, and we're spending a lot of time doing it. So I hope this is of value. I don't know what your August looks like, but Joe, I've seen the long-term weather forecast in Texas, and we've had a pretty hot couple of months. Yeah. And let's just say hot August, a lot of hot things are going to happen.
That's for darn sure. Hey, and guys, we have amazing guests next week, as we always do. But Eddie, a good friend of ours, good friend of yours, NoteSchool's Dr. David Phelps is going to be our guest next week. So you want to just play a couple of words about that, and then we'll wrap up.
David Phelps has an incredible audience of dentist freedom founders, and he just is a really squared away industry guy. He has become definitely his own economist and a market forecaster, somebody that I just dearly respect for his knowledge and depth in the market. And he wrote an article about the economy. And I think it's really, really good. And it's hit some of the national news publications. And so we're going to have Dr. Phelps on with us, and he's going to talk about that article, and we'll share it with you guys. And if you are interested in the economy, this guy's worth listening to. So we're going to look forward to having my friend, Dr. David Phelps, with us next week, Freedom Founders. And I guarantee you it'll be something that you want to watch.
Hey, guys, as Eddie said, make sure and share this episode with everybody you know. And, hey, we'd love to have you come to one of our 2-hour master classes. It is done by Mr. Eddie and our Chief Market Officer, Mr. Max Keller. And it is I'll say Keller, and then I'll say it is a killer 2 hours, guys, where you'll see at a deeper dive what we're all about at NoteSchool. So just go to noteschool.com/TV. And just put in the subject line, I want to attend the masterclass, and we'll have a conversation with you. Guys, thank you so much. Eddie, thank you.
All right, Joe, thank you. See you guys later. Bye-bye.